Hi, thank you for joining me. In this video, we're going to talk about banking and saving considerations. I'm Carol Roberts, the Community Resource Development Agent for the University of Florida IFAS Extension in St. Lucie County, and this is just one of a series of videos that I have posted online about financial skills. And today's financial skill is to talk about how to use banking services effectively. Because, we're often told by financial advisors, our parents, and other adults that we need to have a bank account. And a bank account is a great way to keep your money organized and available, but protected. We'll talk about all the advantages of having a bank or credit union account to manage your money. However, there are some things to know about banking and saving and the way financial institutions work that will help you to have a better relationship with your financial institution so that you can get the most out of having that account and make sure you avoid any pitfalls that our financial institutions have laid in our way. So before I get too deep into the woods, let's get started, okay? So during our time together, we're going to talk about several things, but by the end of this session, we're going to make sure that you know the difference between a commercial bank and a credit union. We're going to talk about the advantages that each can offer to their clients, their customers. We also will become familiar with different kinds of banking terms and procedures that banks and credit unions, financial institutions use. So we know how that works and how we need to navigate the system so we have a better experience with those procedures. And finally, we're going to talk about different ways to save at your financial institution. So we're going to wrap it all up with that. And here we go. As we get started, I want to make sure that we're all on the same page with some financial terms that I might use. So let's go through them one by one. You've heard of the Federal Reserve and the Federal Reserve System. This is the Federal Reserve is referred to often as the bank's banker. The Federal Reserve System sets banking policies and interest rates that banks will have to pay to borrow money from the reserve system. And without getting too deep into it, banks borrow from the Federal Reserve on a regular basis to make sure they have enough cash in their institution to meet their clients' needs. And there's a rate that's set by the federal government for that, by the Free Open Market Committee, the FOMC, that guides the Federal Reserve System. They use economic indicators to let them know whether they should raise or lower interest rates to make borrowing easier or harder so that they can keep the economy balanced a little bit. A whole other class on how that works, but know that the Federal Reserve System is the guiding system for all financial institutions in the United States. When you make a withdrawal, that's the act of taking money from your established account. You'll have a withdrawal slip or some sort of tool to use to make that removal of money from a financial institutional account. That's a withdrawal. The rate of interest. So I like to say the goal is to earn interest and not pay it. When you have a savings account or have invested in or have put money into a certificate of deposit, a CD, you are interested in knowing what the rate of interest you will earn on that savings as some percentage. When you borrow money, it's important to know the rate of interest that you'll be paid to pay that money back. You pay that money back, but the lender says that, I'm going to need you to pay me a little bit extra for my ability to lend you money. That's really what the interest is. It's because, as we've talked about in another lesson, the value of time, or the money loses its value over time. So in order to keep the lender from losing money when they lend money to someone else, that person pays the money back with interest, some percentage of what was borrowed, so that the money that is returned to the lender still has hopefully the same value it did when they lent it out. Big explanation, but we really want to be concerned with what kind of interest we'll be earning when we save our money, and what kind of interest we'll be paying when we borrow money. The minimum deposit, some accounts require that there is a minimum deposit made when you put money into an account. Dividends, when you have a savings account or invest, the money you make on top of your money is called dividends. When when the financial institution pays you the rate of interest on your savings account, those are referred to as dividends that are paid to you. The money your savings earns on top of just sitting there. Deposit is the opposite of a withdrawal. It's when you actively put money into an account at a financial institution. You could make a deposit into your checking account or your savings account, but that's the act of putting money into that account. You're depositing funds. If you have an account at a credit union versus a bank, they don't call it a checking account like a regular bank does. Credit unions refer to their checking accounts as share draft accounts. You as a credit union are sharing in the financial stability of that credit union. You're a share member, and a draft account is where you draft funds out of your, in theory, savings. So that's using a check or a debit card to make that funds withdrawal. It's called a draft. So that's just a term credit unions use instead of the word checking account. Just know that if you're working with a credit union, they're going to refer to your checking account as a shared draft account. And then if you're at the regular bank, like not promoting one bank over another, but say a local bank or a national bank like Chase or Bank of America, they're going to call where you keep your money and are able to write a check from it to use that money or use a debit card. They're going to call that your regular checking account. A minimum balance, that means that your financial institution says, we will let you have this account, but don't go below this balance amount. Let's say we're going to let you have this savings account and we're going to pay you this higher interest rate as long as you leave this much money in the account. If you go below the minimum balance, if you make a withdrawal that puts your account below that minimum balance, we're going to have to apply a fee to your account. So watch out for accounts that require a minimum balance. Sometimes some of us use our money in a way that there are big sways in our balance, and we might not be comfortable with a minimum balance. Some of us look at our balance and say, I am never going to go below that amount, and we give ourselves a minimum balance amount. It's not a bad trick to have. Board of directors. Now, in a regular, normal, a bank versus a credit union, the bank is run by a board of directors who make the decisions about how that financial institution will operate. The board of directors are most interested in making sure that that bank is profitable, especially for its shareholders, the people who invest in that bank. So board of directors is the governing body of a commercial bank. Deposit insurance. Ooh, this is important to know. With a regular bank, you might have seen the letters FDIC, Federal Deposit Insurance Corporation. That's deposit insurance. And that's where that bank is saying, if for some reason our bank fails, the FDIC has guaranteed everybody's money in our bank's accounts up to a certain limit. We'll talk about that in a minute. And if you're with a credit union, there is also deposit insurance. Your funds are insured, but they're insured by the NCUA, National Credit Union Association. Funny enough, the FDIC and the NCUA both have the same protections, up to $250,000 for each account and each account holder on that account. So your money is pretty secure up to a high dollar amount. My goal is to one day have more in an account that the FDIC would insure. That's just my goal. Stockholders. I mentioned the board of directors are working to make sure that the financial institution that they direct is profitable for the stockholders. And I mention this because that's the difference between a bank and a credit union. A credit union is run or operated by its members. In a credit union, all the shareholders, account holders, are actually the managers of the bank. You have the right to vote on how your bank operates, your credit union operates, and credit unions are working for the financial stability of its members. So versus a commercial bank that's working for the financial stability of its stockholders. And that's why credit unions can oftentimes, not always, but oftentimes offer higher interest rates on savings accounts, lower interest rates on borrowing, and more perks for its members. However, they don't often have the funds that maybe national banks do. So sometimes their online banking systems are not quite as robust as you might see with some of those well-known national banks. And that's the difference. We'll talk a little bit more about differences. And yes, we are going to talk a little bit more about those differences between a bank and a credit union. And just so you understand the difference and how they operate. So at a credit union, you are, like as I mentioned, a member of that credit union. You share in the profits that financial institution might make. You also share in the decisions about how that financial institution is run because you are a member and you have a vote on how that works. You, as I mentioned, you can get often better rates, interest rates from a credit union because they are working for the benefit of their members versus their shareholders. There may be limited services versus a common commercial bank. Maybe not as many investing services that might be offered or different kinds of accounts. So there may be a limit in services that you have access to. And they are known to have limited locations. However, credit unions several years back recognized that was a deterrent for people interested in having a credit union account. So they have enacted across many credit unions, most credit unions, a shared banking system. It's a software system that connects credit unions together. So even if you are a member of a credit union here in Florida and you're on vacation somewhere in the rest of the world, another part of the country, you can go to a local credit union there and have access to your own funds, just like you would if you were with a commercial bank that's in every state in the nation. So they have overcome that pitfall about limited locations in a way. Also, I mentioned the NCUA. That's the National Credit Union Association that guarantees your funds in a credit union account. Where you're not a member, you are an account holder, and the bank wants to make sure that you have a good experience as an account holder, but they are not working for your profits. The bank is working to make sure that their shareholders receive a profit of what that bank, how stable and financially progressive that financial institution has become, right? And the decisions are made about that financial institution's operations are made by the board of directors, not the members who have an account there. Banks can offer, like I said, a wider variety of options and services than most credit unions can, just because they have more access to resources. But your account is insured by the FDIC, the Federal Deposit Insurance Corp. So there are similarities and differences between a credit union and a bank. It's up to you where you decide to keep your money. Just understand the differences. And I do want to address the question of why have an account at any financial institution at all? Can't we just keep our money in our pocket, in an envelope under the bed? Why do we need a bank or a credit union at all? Well, because of the protection. It gives you a secure place to put your money so that it can't just disappear, as easily, especially if you have a lot of it and it might be hard to manage. It helps with your financial stability. Some people I've talked to get benefits provided to them on a card from whatever source is providing the benefit. Well, that makes it difficult to actually create a spending plan and manage your money. Some payments can't be made using that card, so that then it's more frustrating to try to keep track of which account is paid with which card, or how much, where is my cash? Why do I not have the money in my account? It's being able to look at your expenses on a screen when you're checking your online bank account provides more stability than going back and going, where'd all my cash go? Just an example. Also, having a financial institution, an account somewhere, helps you to avoid some fees and charges that you might have to pay if you were using a check cashing service, a money sending service. Some of those are free and some do have fees associated. However, I'm not going to ignore the fact that many financial institutions also charge a wide variety of fees and apply charges to your accounts. We have to recognize, in whether we're using a financial institution or not, the costs associated with spending our money, and make sure we're minimizing that, right? Free bank accounts are a benefit, but if there are a lot of parameters on those free bank accounts that end up causing us to incur more fees than we should expect, that could be a problem with having a financial institution account at all. So, a lot of us have already learned how to use those services for less cost than, say, an overdraft fee. And that's not a problem. Just make sure you're minimizing the costs it takes to use your money. That's all I want to say about that. And a nice thing about having an account at a financial institution is it does help you build a financial history that lenders can use to make a decision about lending you money. So it helps. You can look back at online statements, find out where your money has gone, kind of start to use that data to develop your spending plan. And it's a lot of good information that helps you to keep better control of your. So real quick, we're just going to go over some of the steps involved with opening a financial account. This is just a generic explanation, so each institution will be different. Our first step is we want to make sure we want to select the place we're going to open an account. And one of the best places that I know of to go to research different accounts is bankrate.com on the web. So you can do all that research even before you leave the house. You might want to find a bank or credit union that is near your home or work. So if you actually have to go to that establishment, it's close by. That may or may not be important to you. And you want to find the institution that has the services that you need and the interest rates that you're looking for. So at bankrate.com, on their account finder tool, you can put in parameters like, I want to make sure that I have no minimum balance requirement, and I want it to be close to my house. Pick those parameters and it'll spit you out a list of the banks in your area that meet those terms. And then you go to that location or go to their online banking site to open that account. Make a note if the place that you've decided to open an account requires that there be a minimum deposit to open a savings account, you want to make sure you have that amount. Some accounts, some institutions will let you start an account for as little as $1 or $5, and that can be a benefit to just get started. So you want to go to the new accounts department at the bank if you're going there in person, or find the link on their online account, online software. You'll need to, at some point, sign a signature card and provide that financial institution your social security number, so be prepared to offer that. If someone is co-signing on the account with you, if there's going to be more than one account holder on that account, such as like a parent or a spouse, they also need to sign that signature card to be a joint account holder and provide their social security number. And then you receive, once you sign up for that account, you receive some sort of a passbook or a logbook that helps you keep track of your activity in that account. Deposits, withdrawals, and fees. You want to keep on top of the money moving in and out of that account. And then you'll need to get from the bank a supply of deposit or withdrawal slips if you're going to do that in person, or get comfortable using their online mobile deposit tool. Those are really handy. So the ability to bank virtually has really changed the financial industry, the financial industry, and made things a lot more convenient for people, a little less stuffy for customers. You know, sometimes we walk into that bank lobby and everything's all leather and a marble, and it's a little bit intimidating. So banking online has really helped to take away some of that intimidation and level the playing field, if you will. Speaking of online banking, let's just talk for a minute about some of the advantages versus the disadvantages of doing that, and some things to keep in mind. It's very convenient to bank online. You can bank 24/7. We don't have to wait for banker's hours, 9 to 3, 5 days a week. We can do this 7 days a week in the middle of the night if we want. And studies show that people who have an online bank account are more likely to check their balances on a regular basis and catch negative activity as it's starting or early enough to take steps against it. So there is a benefit to online banking in just that way. The accessibility is wonderful. You can be anywhere in the world and get to your bank account. The efficiency is great. Instead of having to drive to the bank to make deposits, you can do that online with your smartphone. And transactions happen in real time. You can transfer money just before you go to spend money that you know you don't have. So there's, being able to bank just in time is a benefit for a lot of us. And it's very effective way to keep track of your money, especially since a lot of these online bank account providers are including budget tools and credit monitoring tools as part of the services they offer. So very effective way to keep control of your money. There is a learning curve associated with using those tools though, so we want to get comfortable with that, and we want to make sure that we are securing our account, because some people are not really comfortable with the security available from their bank. Sometimes we're just newer to using online services and have a trust issue with how secure that account might be. So, that is something that people have to consider. Look for a bank that offers two-factor verification for when you're signing in. That gives you a little bit more security about how protected that account is. So when you bank online, you will get a personal identification number, a PIN. Protect that PIN. Don't write it down and make it available for others to find if they stole your wallet or looked under your mouse pad. Choose a number that you're likely to remember and memorize it. Check your account often. Like I said, people who bank online usually do, but don't let it sit there. Keep track of, at least check once a week to make sure that there are no unexpected fees that have been applied to your balance, and there hasn't been any unauthorized spending on your account. And of course, if you lose your card associated with any bank account, especially online banking, you want to report that lost or stolen right away so that the bank can take protections to protect your money and get you a new card. Check used to be a very common thing, and thanks to those plastic debit cards and credit cards and the ability to bank online, we're writing checks a lot less often, especially to pay our bills. But just so you know, there are some key things about writing a check. If you have to, you want to know these things. Make sure that you are not backdating. You want to put the actual date on the top line up here. The pay to the order of. Be clear and concise about who you're writing that check to. And see with this, if you can follow my mouse, this line here, we write the amount of the check in numbers. But this line below pay to the order of is where we write the amount of the check spelled out in words. And be careful to not leave too much space so that somebody could add out maybe a 100 before your $8.50, so that you're not frauded into spending $100 more or more than you expected. On the memo line, that's your information to help you keep track of who you made this payment to and why. Sometimes your account holder will require certain information on the memo line that helps them identify who you are, your account number perhaps. And then there's a signature line where you want to make sure that you sign your name in a consistent way with the signature card that you signed when you applied for that checking account. Those signatures should match. If they don't, your check may be sent back for verification or not paid to whoever you're trying to pay until they can verify that you actually did write that check. A little bit more information you might want to know about a check. Down here at the bottom, this number right here is your account number, and then your routing number for your bank. Every bank has a routing number that identifies their financial institution. So when somebody cashes one of your checks at their bank, the Federal Reserve System knows where that check should come out of. It's how they track numbers. But know that, and up here you'll see this is check number 127. Down here below your signature line is that same number that verifies. That is check number 127. When you're making a deposit at your financial institution, whether it be a bank or a credit union, there are different ways to do that. You can use their online system to make an electronic deposit right from your smartphone. That's an easy way to get your money into your account, and your financial institution will provide step-by-step instructions for making an electronic deposit. You may actually go to the brick and mortar financial institution, that physical space, to make a deposit. And that's another way to get money into your account. Your employer or somebody paying you might provide a direct deposit. Even the IRS now will offer income tax refunds as a direct deposit. So the financial institution or whoever is paying you, your employer, sends that money directly to your bank, and you don't have to make that physical deposit in any way. So that's an easy way to get your money into an account. Side note, if your employer does direct deposit your paycheck, you can opt to have that paycheck split into different accounts so that you can automatically save. Personally, I have separate bank accounts for my vacation savings, for my grandkids' savings, for my own checking, and for my own savings. So bank accounts, you can get them for free, and tell your employer all the different places you want this much of your check deposited into, this much, this much, and they do your banking for you. It's kind of nice. All right, so if you're making a deposit, you may have an actual check to deposit, whether it's electronic or physical. That check has to be endorsed in some way. Endorsing a check means that you are taking ownership of that check. There are different ways to endorse a check. There's the blank endorsement. That doesn't mean leaving it blank. That means that you just sign your name on the back of that check. It's all you do. Your name is there. Problem with a blank endorsement is if you sign that check, just a signature, and you lose it, whoever picks it up now has the ability to cash your check because you've signed it. So there isn't any other information on that check that will stop them from cashing your check. It's already been endorsed. You can protect yourself by adding a restricted endorsement. A restricted endorsement refers to the fact that you signed it and wrote the account number of the account where that money is going on the back of that check. So that's a restricted endorsement. Also, when you're making an electronic deposit, your bank, your financial institution might require you to write on the back of the check, for mobile deposit only to blah, 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 credit union or bank, along with your signature. That's the bank asking you to restrict that endorsement in some way. And you can also write for deposit only next to your signature and that account number. That means that nobody, if they were to get a hold of your check that's already signed, the only thing they can do is deposit those funds in your account for you. That's very restricted. And what a nice thing for them to do for you. Hopefully you don't lose your check before you have the ability to deposit it. All right, reconciling your bank account. It's one of the hardest chores I think I ever had to learn how to do, but luckily with online banking, it has gotten a lot easier. So when we reconcile our account on a regular basis, that is basically just making sure that you and the bank both agree on where your money went, how it came in and how it went out. So, and that has to be done on a regular basis to make sure that you and the bank agree with all your financial records. If you're going to physically reconcile a checking account, you want to make sure you put all your canceled checks that you received back from the bank in order by check number. And then you're going to match those canceled checks against your checkbook register and the checks listed on this bank statement that your bank sends you on a regular basis. Check off each of the checks, the canceled checks in your checkbook, and make sure the amounts agree. All the record amounts agree. And then subtract from your checkbook register balance any bank services charges and drafts that are on your account that are not already reflected in your register. If you had a fee from the bank and you didn't put that in your bank checkbook register yet, now's the time. List all your outstanding checks, those that you've written but the bank doesn't know about yet, on the back of your bank statement. There's a place on the back of your bank statement to reconcile your account. Use that form, it's really handy. And then total the amount of those outstanding checks, and then subtract that amount from the amount the bank statement says you have. That number should now match with the number on your bank register, your checkbook register. Oh, and especially if you've made sure that any deposits that are not shown on the bank statement that you've made since the statement was printed, you have to account for those too. So anything the bank doesn't know about yet, according to their statement, you need to subtract or add, and hopefully your numbers match. The two numbers should be the same, and if it doesn't, then check back at your math and for any unaccounted for checks or deposits, and keep working at it until you get a zero balance. Why this has gotten easier, especially if you bank online, is that you can look every single day at your bank account and make sure that you and the bank agree. You used a debit card to make a transaction at a store, keep the receipt. Get back in front of your online bank account, you and the bank agree on the amount, you both see that transaction, boom, throw away the receipt if you don't need it for something else, and you've reconciled your account on a daily basis. If you're checking your account on a regular basis, you'll see the fees that the bank might be applying and be able to adjust for that. All right, let's talk about fees. Banks love to fee us to death, don't they? There are fees everywhere. And I hate to have to report that financial institutions make record profits every year, year on year, based on the amount of fees that they collect. If we, as smart consumers, understand what the bank is going to charge us a fee for, oftentimes we can behave in a way that avoids those fees. So, and the nice thing is recently there's been a trend with the major banking institutions in eliminating or reducing overdraft fees, because it doesn't make sense for them to charge us a fee because we spent money we don't have in our account. Now they're charging us more, and our bank account is even further away from having money in it. So banks are finally taking that into account and changing their operations so that they don't have to fee us to death. But we do need to understand that there are still fees. There are many different types of fees. If you need help reconciling your bank account, the bank will do it, but they might charge you a fee for it. If you make a foreign transaction, there might be a fee for converting those the dollars into whatever foreign currency that place used. Even if it's an online purchase made with a foreign company, you might have a foreign transaction fee. Overdraft fees, very common. You spent more than the money you had in your account. The bank went, hey, yeah, we'll let that transaction go through, but we're going to charge you a fee for that. Account opening fees, account maintenance fees, all kinds of fees. Understand what fees are associated with that account so you know how to avoid them or reduce them. Know your account terms. This is where I mentioned minimum deposit or minimum balance. If you don't meet the minimum, you may incur a fee. So understand those terms on any account that you have at a financial institution, and then avoid the actions that cause fees. You can actually opt to be out of overdraft protection, which means if you opt out of overdraft protection and for some reason you make a transaction with your debit card that is using up more money than your account has available, then the transaction will not go through. If you opt in for overdraft protection, that same transaction, the bank would allow it to go through. They would just charge you a fee for allowing you to spend money you didn't have yet. So understand the terms that on your account that cause fees and avoid the fee activities. So some of us have already had a negative experience with a checking account, and perhaps we've been blocked by a bank from having an account, or we know we left an account in a negative balance somewhere, and we're concerned we may not be able to get a new checking account. We're just having to use all those different check cashing services because we've lost our ability to have a checking account at a financial institution. Luckily for us, there is a thing called second chance checking. And this is the bank or the credit union saying, we know you had a problem in the past. We're going to give you an account, let you have an account that has maybe less features, and there might be a fee for it, but we're going to give you a chance to show us that you figured out how to manage your money a little bit better, and you're not going to leave us in a lurch again. So, but this is just a time-limited checking experience. So first, it's an alternative account for those who have defaulted on a checking account in the past. And then you won't find a free second chance checking account that I have said. If you do, email me, let me know who's doing that, because that'd be awesome. But so it won't be a free account. There might be a $5, $10 monthly charge for having the account, but that fee should only be temporary until you've managed that account in a positive way long enough. Then the bank says, hey, you got this. Let's convert you over to a free checking account. There are a certain number of months that you've kept that account in the positive. So if it's not free, it's probably just temporarily not free. May not have some extra services that you would have with a regular checking account. Maybe there are fees for deposits or something like that, but when you have kept your checking account in positive for the required amount of time, then you'll be able to convert to an account that has those services you're looking for. And this is a great tool to help reestablish a financial relationship so that you can take advantage of the low cost, no cost at all checking and bill paying services. And it's just there so you can start to bank again. One benefit of reestablishing or establishing that relationship with your financial institution is that you start to save. Yes, being able to pay your bills using an online checking account or a debit card, credit card is handier, more convenient, but also having a savings account, a place where you can automatically transfer money into an account that is not as easy to do as having cash sitting in your wallet. That can make all the difference in getting your emergency fund and your savings account established. So, and then once you do that, once you get the savings and that is emergency fund established to a certain dollar amount, then you can take that money that you're automatically saving and start automatically investing. And that is step 3 of the 4 steps to building wealth, right? Make the money you don't spend work for you. We have to have other things in place before we can do that. That's a whole other video that I hope you'll get to. Right now, let's look at the difference between what saving and investing is. Saving is actually just the process of setting aside current income for future use. You put that in a separate account, which is safer, because if you just leave it in your checking account going, I won't spend it, Deal with me, gets spent. Investing, however, is committing money or capital in order to gain a future financial return. There is no guarantee that that money will be there in the future. That's the difference between saving and investing. The only time your savings are removed is when you remove it. With investing, if you commit money and that investment does not perform as you expect, then that money is taken away, not by you. So basically, with saving, the only time your money is reduced is when you remove it. And why do we need to save? Well, because life happens. And we need to have a pool of money for when that life happens. And there is, like I mentioned before, a thing called the time value of money. $1 today will buy less than $1 would a year ago, right? Cost of bread goes up, cost of gas goes up. It takes more dollars to buy what we were buying a year ago, the same amount of what we were buying a year ago. So there is a time value of money. If you aren't saving, then the value of the dollar that you have is being reduced because $1 received today is worth more than $1 received in the future. So if we're not saving our money and earning some sort of an interest rate to maintain its value, we're actually losing money. So you need to earn about the same amount as the inflation rate. Normally, average 3%, that changes, 3% annually. You need to earn about the same interest as the inflation rate, the annual inflation rate, to help your money maintain its value. If you can earn more than the current inflation rate, then you're building money. And another reason we need to save, like I said, is because emergencies happen. And when we're not ready for them, they can impact our pocket more than we want them to. So be ready with an emergency fund. And that way, when life tries to knock you back, you have the money to not get knocked back so far and still keep moving forward to reach your goals. It's a nice tool for stability. So how much do we need to have in our emergency fund? Well, financial advisors will say 3 to 6 months of living expenses. If you were to lose your job tomorrow, it might take some time to replace that job, right? You're going to have to pay bills between now and when that next paycheck starts coming in, because it's not just taking time to get a new job. It takes time to be at that job to get your first paycheck. So 3 to 6 months of living expenses will get you through. How do you know what that dollar amount is? Well, how about if you did your spending plan, whole other video that you can also find on YouTube, and you calculated your fixed expenses, then you already have that number for a month's worth of living expenses. Multiply that number by 3 and you have the least amount you should have in your emergency fund. Multiply it by 6, and then you have the amount that you can pretty much safely say, after I get to this amount, I can start investing with the money that I don't spend. Earlier in the video, I mentioned the miracle of compound interest. And that's one of the benefits of financial institutions having a savings account is you are most often paid compound interest. That the money you put aside, the bank says, we're going to pay you a little bit of a percentage to thank you for letting us hold your money. And then next month, if you haven't spent that money, we're going to give you a little bit of that same percentage on not just on your money, but the money we also gave you last month. So as you build that account and don't spend the money, the more money they give you each month for having that much money in your account. And you'll see on the screen the difference between simple interest, where a financial institution just pays you interest on your money, and compound interest, which means they compound what you have saved and what they've given you. See that split? The more you save, the bigger that gap grows. So that's the miracle of compound interest. On the left side of your screen, you'll see the mathematical calculation that explains the difference between simple interest and compounded, and it just gets you a little bit more money, and which that little bit grows over time. That's all I need you to understand about that. All right, so now that I've hopefully enticed you to make sure that you have a checking and a savings account, now we got to look at ways to save so we have some money to put in that account. And there are different ways to look at this. Well, one of the most common ways to save is save a windfall, some unexpected money that you got. Often a lot of us get that end of the year income tax refund, which is an annual windfall of money, and that can be a good place to get that windfall money to start an account with. Deposit that. A lot of us do plan that income tax refund for big ticket item, big ticket purchases, and that's okay. The IRS actually provides a form that you could submit with your tax return to split that windfall into different accounts. You could actually have half or some dollar amount of that refund deposited into your checking account so you can still buy that big ticket item, but then have some of it go automatically into a savings account to boost that savings level right away. And then you're being responsible and getting what you want at the same time. The IRS calls that split to save, and the form is easily found if that's something that interests you. Other ways to save: trim your excess spending. But realize there's a difference between spending and saving. Think about it this way. When you go to the grocery store and you get your receipt after checking out, and it says on the bottom of the receipt, you saved $5.99 by taking advantage of their store coupons and store deals, right? You always see that number. But did you actually save it? No. That wording is wrong. You didn't spend that $5.99. If you make the action of taking that $5.99 and putting it into your savings account, you actually did then save that money. But technically, until you do that, all you did was not spend that money. So knowing that when you don't spend that money, you can actually make the effort to put that money into your checking or your savings account, and then you have saved that money. So when your electric bill is down because you've made the effort to turn off TVs when nobody's watching, turn off ceiling fans when nobody's in the room to feel it, all those things you can do to trim excess spending, the next step, once you've trimmed that, your bill is lower, you take what would have been on that utility bill out of your checking account and move it over to savings, and then you have saved. Avoid credit card use. That is a whole other video as well that you might want to look up about credit card use and how to manage your credit, but keeping more of our current money in our pocket helps us to be able to save. Not having to pay interest on our ability to use money we don't have yet using a credit card helps us to have more money to save. So avoiding credit card use is kind of a way to trim excess spending in a way. So redundant, but does help us have more money to save. Pay yourself first. You know, in business, they tell business leaders this. In general, if this business can't support the most important employee, the owner, then maybe we need to rethink this business. Same thing with our finances. If your income, your paycheck can't support the most important person, the person earning it, then we need to rethink this, possibly. But pay yourself first. Set up that automatic deposit. When your paycheck gets direct deposited into your checking account, you can split your direct deposit, for part of it to go into your checking account, or set up a recurring transfer. So that maybe a day after your paycheck goes in, some dollar amount automatically is transferred by your financial institution into a savings account. Without you even having to make the effort, you have paid yourself first. You put your money in savings, and because you're just as important as everybody else who gets your money every month, the landlord, the utility company, the car lender, auto loan lender. You're just as important as they are. Oh, this is a good way to save. Continue an installment payment once a loan is paid off. You finally got that car paid off. Your budget was used to spending what, $300-400 in a car payment? And now you're going, yay, I don't have to pay that anymore. Well, if you let it just sit in your checking account, I would estimate that you'd probably be soon experiencing a term called lifestyle creep. When we see we have a little more money, we tend to spend it. So if you set it up so that installment payment for your auto loan automatically now goes into your savings account, it's still coming out of your budget. It's just going to you instead of the auto loan company. There's a nice way to save. Collect your loose change. Have that jar where you can, if you've gotten change back from paying for something, you can throw that loose change into the jar, and every so often, every couple of years or so, pull that change out, count it up, and see how much you were able to save. You don't even feel the pinch from saving when you do something like that. Break a habit. I have a friend who stopped smoking cigarettes and now puts the cost of a pack of cigarettes a day into the savings account, and that has been their way to save. So, you might think about using that tool as well. But little ways we can trick ourselves into saving because sometimes we need that. So the next thing we have to look at, once you've figured out ways to save, so you have that little bit of money to put aside, where are you going to put it? Where are you going to put your money so it's safe and secure while it grows? We've talked about financial institutions and bank accounts, but let's talk about some of the different kinds of accounts we can use now. I mentioned this before at the beginning of our time together, insured savings accounts. That means FDIC, Federal Deposit Insurance Corporation. It insures our savings or our checking account at a commercial banking institution up to $250,000 per person per account at that institution. So there is a safety in using an insured savings account. Your money is liquid, pretty liquid. If you don't know the term, it just means how fast can you actually access this cash if you need it. Well, in your savings account, it's pretty liquid. You can go to an ATM machine and withdraw your money if you need it 24/7. So that's a handy thing. It can earn interest in your insured savings account. Probably not going to be a lot. I have seen online bank accounts that were up to 1% interest, but usually it's 0.01% interest or 0.03. So, that's something to look at when you're trying to make your money earn money. And it's really easy to get your money in and out of an insured savings account. You just make deposits or use the ATM, go through the bank drive-through. Awesome. And what you want to look for are no fees on your savings account because, like I mentioned, that interest rate they're going to offer you is pretty low. And if you don't have a whole lot in there, you could end up spending more in fees than you are getting in interest. So that would be a negative situation that would cause you to lose money instead of earn it. Look for no fees if you can. No minimum balance, just in case. So if you have to use the money in your savings account because it's maybe your emergency fund and you had an emergency, make sure that you don't get hit with a fee for going below a minimum balance. And you want to look for compounded interest at the highest annual percentage yield possible. Does this account offer you 0.01% interest or 0.1% interest? 0.35 is a couple of online accounts I've seen lately, or even youth accounts. I know of one local credit union that offers a full 1% on a youth savings account. Something to look for. But that's what you want to look for. No fees, no minimum balance, and the highest annual percentage yield possible. One interesting way to save that financial institutions offer are certificates of deposit, CDs. These can be a really good tool for earning a little bit higher interest than a savings can offer. Because you agree to leave your money with that financial institution for a set period of time, then the bank, that financial institution says, hey, thanks, we'll give you a little bit higher interest rate. Because you've committed your money for this certain period of time. It's not as liquid because you've committed your money for a certain period of time. If you happen to need the money you used to get that certificate of deposit before the time period is up, you're going to be hit with a high fee, and it's going to take time to get your money. You have to wait for that period of time is up to get your money back without incurring a fee. So if you sign up for a 3-year CD, you will earn a little bit of interest, more interest than a checking account, putting that money in a savings account for 3 years, but you won't get that interest for 3 years. So time-specific savings period, like I mentioned, fees for early withdrawal, like I mentioned, if you need that money before this time-specific savings period is up. Certificates of deposit are insured by the FDIC, which is a great, another safety feature that's a benefit. And you can usually get into a CD at a financial institution for $500 or more. And I think the lowest time period is about 6 months, I think. That's standard, but all financial institutions, they create their own products sometimes and have a little bit of different features. Check out the differences at your financial institution. All right, I can't pass up the topic of cash, actual cash for your savings, because you can leave your money in cash as a savings. You aren't going to earn any interest on it. It's going to sit there and over time lose value because prices go up. So it can buy less. It's not quite as safe because somebody can find it and it disappears without you taking it out. But it is pretty liquid. If you need it, it is right there to go grab and buy something. You don't even have to wait in line at the ATM. It's already liquid for you. Another way to save that I just wanted to touch on that some people use is the cash value of life insurance. So people will buy a life insurance policy, a permanent life insurance policy, instead of term, so that they can use the features of that permanent life insurance policy while they're still alive. And that includes, it can be a form of estate planning to have that cash value life insurance, because it will be there for your family upon your death, but while you're still alive, you may be able to use the cash value that life insurance earns. It's kind of a forced savings element, and you can borrow against the value that life insurance policy gains over time. So it's a couple of steps that it provides all in one tool for estate planning and use of savings now for an emergency situation. But if you really need the money from that life insurance policy, you can turn that whole policy in sell it for the value that it's earned and get a windfall if you need it, but otherwise it is there to borrow against as well. But keep in mind, with life insurance, you'll be working with a life insurance agent. There may be high upfront fees and commissions that go with the purchase of that policy, and you really want to work with someone experienced to get the right policy that's going to benefit you, not only currently in your, if you're using it as a savings tool, but also will provide a benefit to your family in the long run. Like I always like to mention, the goal with a financial institution and saving is to earn interest, not pay it. So we want to use these tools to build wealth, not debt, and become a responsible St. Lucie County saver. Just to mention, there's an organization called americasaves.org. That's their website, americasaves.org. And if you're interested in saving tools and other savings techniques, you might look them up, take a pledge to save, and watch some of their videos. You can actually get a prize, a money prize, for watching their savings webinars. And that's a good way to start building that emergency fund or that savings account. So just a little plug for America Saves. They're a great institution for helping people learn different ways to build that financial stability with a savings account. Thank you for joining me. My name is Carol Roberts. I'm the Community Resource Development Agent for St. Lucie County, and it's been a pleasure spending this time with you. I hope this has been helpful information for you. Join me for the other videos I have in the financial series, 4 Steps to Building Wealth, also found right here on this YouTube channel. Thank you.